So the next session, it's called Informed Investing. It's an LSE panel, navigating exits. The panel moderator will be Abi Ajayi. He's the head of primary markets, Middle East and Africa at the London Stock Exchange. Abi is the head of the primary markets, Middle East and Africa at the London Stock Exchange with principal responsibilities for the development of the capital markets, businesses promoting the unique market model and benefits of listing in the region. Prior to joining the London Stock Exchange, Abi was responsible for coverage of clients in the sub-Saharan Africa at Bank of America. In his role, he led various mergers and acquisitions and capital market origination, raising over 25 billion for corporates, private equity, governments, and government-related entities operating in the region. Prior to his time at the bank, Abi worked at the Chapel Hill Advisory Partners, where he led and executed capital raising and advisory transactions. Abi holds a Bachelor of Science in Computer Science with Economics, a Master's of Science in Information System, and a Master of Business Administration from the London Business School. So welcome, and you can go ahead. Thanks.
Thank you. Thank you. Good afternoon, August visitors. Delighted to be moderating this panel today on exits. I don't think I need any further introduction, but to my left, we've been intentional about people around on the panel here today. We've got an operator, a company. We've got a portfolio owner, AFSIC Capital, and then we've got an M&A advisor on this side. To the best of, I'm going to try as much as possible to limit how much it is that I say, because we really want to hear from members of the ecosystem here, and to the best of my ability, I would intervene as appropriate. But I think as a way to set the scene, I would let of course, ladies first, for her to tell us what she brings to this panel and why exits, the question around navigating exits, why it's important, particularly for Africa, because then investors not only just want return of capital, they also want return on capital. Over to you, Yara.
Thanks for the introduction. My name is Yara El Abd. I lead investments at Value, which is one of the biggest fintechs in Egypt. I've been working in financial inclusion for the past 14 years in different forms, whether through DFIs, the public sector, and most recently the last 8 years through fintech. I had co-founded a fintech startup in Egypt that was acquired by Value a couple of years ago, so I have that angle as well to bring. Value is also at a later stage now where different exit options are on the table that we're also considering, so I have that to bring to the conversation as well. And I think that maybe our opinions on the panel might not always be aligned, and I think it's going to be an interesting discussion.
Okay, good. Looking forward to that. Mike.
Hi, everyone. Mike Mompi, one of the co-founders and managing partner at AFSIC Capital. AFSIC, it's derived from the Zulu language. It means to build, to make, and to create. And we back founders and teams using technology to solve large and meaningful problems across the continent. So we're a venture capital fund, and we're investing from pre-seed through to Series B. We've been investing out of this firm for the past 5 years. We have two kind of structured, traditional kind of 10-year venture fund vehicles and one growth fund. So if anyone has come here to hear a venture capitalist's perspective on successfully exiting businesses across Africa, I am not that person to get that perspective. I'm not sure how many of those firms or individuals exist across the continent, but it is something that we are actively working on with our portfolio companies, other investors in the ecosystem as well, and we know that it is a core piece of the puzzle when building a thriving venture, private equity, and kind of funding ecosystem across the continent.
Edmund.
There's
a reason why you're in the middle, right? Because I know you've done quite a number of M&As on the continent, helped on the strategic side. So please tell us.
My name's Ed Higginbotham. I'm Managing Director of Verdant. So Verdant has two businesses. We're a medium-sized wholesale financial institution. We have two businesses. We have an M&A business, which is now branded Verdant IMAP. That business does M&A for the middle market, mainly private company M&A, a lot of M&A for venture-backed businesses, a lot of M&A for private equity-backed businesses, a lot of M&A for generational companies as well. Secondly, having learned an awful lot about doing exit for private equity and doing a lot of exits for other people over about 10 years. 3 years ago, we started our own private capital fund. And that private capital fund is investing mezzanine. It's investing self-liquidating instruments, or mainly self-liquidating instruments. And I'll tell you a little bit on this panel why Verdant went the self-liquidating route rather than the traditional private equity route for its Vintage One fund.
I think it's a good segue there. Tell us, why did you do that? Because oftentimes when I hear from investors that one of the big challenges they have with investing on the continent is around exits, that there are not enough exits, both on the M&A side, with IPOs. What has been your experience, and are there specific challenges you want to speak to?
So I'd like everybody in the audience to roll their minds back to when they were in their late teens. And when each of you had your first driving lesson, and you sat in the car for the first time, you had your hands, the first thing you do is told how to handle the steering wheel. After being told how to hold the steering wheel, the next thing you were told how to do is to stop the car. You were taught how to stop the car, or I was certainly taught how to stop the car. You were taught how to use the brakes before you were taught how to use the accelerator. For quite obvious reasons. I don't think we need to talk about that anymore. We were taught how to use the brakes before we taught how to use the clutch and the gas. So first rule about private equity, before you invest in a business, you need to have a very, very, very clear plan as to how you're going to exit. And you don't need to just have a plan, you need to have a plan A and you need to have a plan B. And honestly speaking, in Africa, you need to have a plan C as well. So that's not a private equity in Africa comment, that's a private equity the world over comment. Know how you're going to get out before you get in. It's kind of, can I say it's common sense? Is that really?
Oh, I think it's
kind of common sense. It is kind of. But I think all of us in the Africa ecosystem, in the private equity ecosystem, this is something we all drilled in, early on in our business school days, or investment banking days, or private equity. So I think we all knew that. So what's gone wrong in private equity in Africa? What's gone wrong with exits? Because something has gone wrong. I'm told by friends and partners in the DFI community and the LP community that the median, this is not the worst or the longest life, the median life of a private equity fund in Africa is 13 years. 13 years. Remember, the fund life contractually is 10 years. So the median, this is not the worst, the median is taking 3 years longer to fully exit than they should by contract. So what's going wrong with that? Is it that there's not enough liquidity in the M&A market? Is it the IPO market? What is it? So I think we'll expand on that on this panel. I've got some more perspectives to share, but the first perspective I would share is liquidity, valuation, and currency risk. If you talk to private equity, the reasons they give for longer fund lives or the issues exiting, they say lack of liquidity in the M&A market, and they say currency. But very, very rarely do they say valuation. And to me, those three things are very, very closely linked. Valuation is the inverse of cost of capital. There's lots of different ways you can look at valuation, lots of different ways you can measure valuation. But fundamentally, valuation is the inverse of your cost of capital. And ultimately, if you're investing in economies, in businesses which are driven by local currency, where local currency sales, local currency costs, local currency profits, if you're investing in those currencies, in those countries, fraudulent slip, if you're investing in businesses in those countries, you need to factor in what is the long-term expected devaluation of those currencies. You need to factor that into your cost of capital. And if you factor that into your cost of capital, you are making investments at a lower valuation level than you did in the private equity community in the 2010s as a generalization. So to me, the big challenge in private equity, there is liquidity in the M&A market. There are people looking to buy companies. But to me, the big challenge is valuation, that too many of the investments in the private equity community in the 2010s was done at too high a valuation. Some of these GPs went back to market and raised new funds, and they said, well, this is what the portfolio is worth, and it's doing well. It's still worth what we paid, and worth actually slightly more now. And then 2 or 3 years after they raised the successive vintage, they then had to go back to the LPs and say, I'm sorry. They didn't want to go back and say, I'm sorry, the valuations were too high. We kind of got it slightly wrong. It's actually much easier to say to the LP community, there's no liquidity in the market, or the currencies beat us. So and it's not strictly true.
So I think the point you're saying now, you're saying that, on the M&A side, that there's a fundamental issue around FX, valuation, and currency risk. That you do not, are you saying that the LPs are not pricing this in accordingly?
I think this is, unfortunately, when we talk about exits today, we're talking about portfolio companies which were invested in, 13 years. We've talked about the 13 years. We're talking about companies that weren't invested this decade. They weren't even invested the second half of the last decade. A lot of these deals being exited were in the first half of the last decade. And I do think in the sort of Africa bull market, Lions on the prowl, the fastest billion, I think there's probably half a dozen, Africa rising, I think there's half a dozen other cliches that we could remember if we all collectively put our heads together. I think in that first part of the last decade, I do think a lot of people in the industry overpaid for assets. Not everybody. Some funds have done very, very well. We can mention names later, perhaps. But I think as a whole, a lot of the managers did overpay for assets in the first part of the last decade, and it's taken 10 years for that to kind of work its way through the system, and in many ways, in many cases, it still is working its way through the system.
The way you're talking, Mike seems to want to close down shop at this rate.
No, I don't think so at all. I don't think so at all. I think a lot of funds have done very well, but not everybody. Hey, sorry, Mike.
Don't apologize.
No, because
no.
If you, and I don't suspect that that's the experience that Yara's had. Yara's successfully exited the business. Do you want to tell us, when you started that business, was it always with a view to exit, or were you always saying, look, I'm going to navigate this way, I'm going to get money from friends and family, raise investors that will follow me through the journey?
Yeah, so commenting on this exit strategy A, B, C, I get that from an investor perspective, that would be the mindset. I do think founder mindsets in the tech space do need to shift slightly, but not towards exit strategy per se. So when we were raising our pre-seed round, I would get asked by potential investors, okay, so what's your exit strategy? And my response would be, don't really have an exit strategy in that way. At this stage, we're trying to get product market fit. I want to build something impactful, scalable, with healthy unit economics. And that wasn't the right answer that they were, or I still think it was the right answer.
I think it's the right answer.
Some investors did not think that that was the right answer. I came to understand. But the investors that did think it was the right answer got very good returns on their investment when we did exit. And I'm seeing that there is a lot more opportunity for similar exits, like the one we had, where strategic buyouts, companies looking to whether expand their geographical footprint or expand their product offering. And even when considering that exit at the time, it was still under the same basic premise of this partner is going to help us build something more impactful, more scalable, with more healthy unit economics. So where I do think mindsets need to shift slightly would be in terms of setting the right corporate governance and financial management in place early on to create the right framework for a smoother exit when the time comes. I think that a lot of startups do fall into that pitfall. And it is much easier to build something right than to build it wrong and then try to fix it later on.
Agree.
So yeah, that was my...
And thank you, Mike. I suspect you might have a different perspective because once you put your hands in your pocket to write a check, you already have the end of the journey in mind or what it would look like.
Yeah, it's a good question, and I think we can all kind of sit here and say kind of there's one right answer when in fact it's too early to objectively say that this is the path and this is the right way across all geographies, across all business models, across all stages, across all types of capital.
Yep.
So, as I hear, I'm kind of agreeing there are things I want to kind of challenge. I'm agreeing there are things I want to challenge. And that's the reality of this nascent kind of an emerging market is that we need to adapt to the realities of the market. So if there are founders who come to us and on a day zero pitch, and we've backed maybe 4 entrepreneurs who were kind of day zero entrepreneurs. And one could say that is kind of absolute insanity. But each 4 of those entrepreneurs had previously built and sold a business, some quite successfully and others for a loss. But if they come to us and they tell us that they have a clear plan to build and sell in 2 or 3 years, it is much less attractive to us than someone who is deeply knowledgeable about a problem that is affecting the masses and has a unique approach to solving that problem, building a business, and has the best team in place to do that. And it's true, we do take a risk because we believe that if someone is able to build that value over a long period of time, that value will be seen and that value will be recognized. Now that's a risk that we're taking, right? And we do acknowledge that. And we know that there are kind of public exchanges, we know that there are kind of trade sales, we know there are financial buyers as well. And we've started to see kind of drips and drabs right, of kind of some of these acquisitions taking place or these liquidity events taking place. But if you look at least the venture dollars across the continent, right, we've surpassed kind of 10 billion over the last few years. We're only seeing charts of money going in. So we're not seeing the charts of money going out. And that is stranded capital. A lot of that's sitting there. Kind of fund managers like myself can report back to LPs and say, kind of, look, this is the net asset value of our firms, but where's liquidity coming from? And so that's why it is important for founders and managers to understand that liquidity is important for us. So we cannot invest if there is no liquidity. And yet investing only to get liquidity, I think, decreases the likelihood that we have a positive outcome. So yeah, go ahead.
No, I agree with you because I think capital only has one religion, which is returns, right? And whether it's M&A, whether it's IPOs, we need to see that capital being recycled. So maybe question back to you, and before going back to Yared, what would you like to see, and what are the shortfalls in sort of the exit ecosystem that needs to be addressed? Because then the opportunity of this panel is to encourage frank conversation. Let's build earmarks on things that need to be corrected and things that need to be fixed. Look, without talking shop here, I work for the London Stock Exchange, and my key responsibility is building bridges across these exchanges and ensuring that that London remains a financing destination for international companies, particularly of African origin, if that makes sense. But we want to do that in the spirit of what I call global, so where it's local investors participating together with global investors, creating a very nice global partnership where London essentially is an extended shopping window into these markets. So what would you like to see? What are the key shortfalls and which markets? Because I understand there is fragmentation in a number of markets. Capital markets are not sizable enough. And of course, when the M&A takes place, then you rob, without it going into public markets, you rob what you call key customers in the local markets an opportunity to partake in that growth, because then they don't participate, because then it takes place in M&A. What are the things, what would you like to see? Because as you're starting to invest, what are the things that need to be fixed? And what is working and what isn't working?
And let me tie back to that. I think that was points for a fantastic question. I think that's what that bell was. And you know, congratulations to the London Stock Exchange for all of the work you do on the African continent. And this is going back to the entrepreneur point. Entrepreneurs need to understand that if they are taking on this capital, that there is a fiduciary duty to create the value and to return that capital. And so one of the things that we did actually earlier this year is with the, we're based in Kenya, Nairobi, Kenya, with the Nairobi Stock Exchange and the London Stock Exchange, we put together an event where we brought together, you know, some of the key advisors in the ecosystem, some of the key investors, some of the key founders, and we had an open conversation. It was the first time. There were quite a few kind of individuals there, kind of from the local ecosystem and from the international ecosystem. We're saying this is the first time we've had a genuine and a real conversation, actually, about what it takes to achieve liquidity, what it would take to achieve a double listing. And the reality is that it takes those connections, that information, and those conversations to push it forward. So there are a lot of things that don't work, but there are things like that that are actually informing people and helping entrepreneurs, helping investors start to take the right steps towards achieving liquidity. Now, IPO it's going to be, you know, a small segment, small subsegment of liquidity. Perhaps value, it's unclear. We'll have large results from the IPOs, but most of the transactions are going to be kind of trade sales. So that's kind of trade sales M&A. We have, for example, 2 portfolio companies where we have US publicly listed companies that are very well known, whose kind of counterparts and business models were investors in the African versions of those, and they've taken stakes because they're very interested in possibly expanding into the market and learning from this company. So we believe that there could be a path through. But I think it's collaboration, it's kind of information, it's knowledge, and it's proactively having the conversations at least. So in addition to the IPOs, for example, you know, we have taken, you know, one of the big, it was a $200 million exit on the continent. We took the founders of that business, we took all of our CEOs, and we, you know, structured a session so they could sit and they could understand what happened, like the play-by-play. Not what did the pitch deck look like, but what was the play-by-play, the day-by-day, the relationships, where did they come from, what was the thinking, kind of how did that acquisition occur, right? And we've also done that with M&A advisors. We've brought bankers in. We've said, pitch to our entrepreneurs. Help them understand what they need to be thinking about, what they need to do today in order to structure, to prepare for an exit down the line. Now, is that going to directly lead to an exit? Not clear, but is that going to increase the likelihood of liquidity, of exit? Absolutely. We have no doubt about that.
Okay. And yeah, I'm just going to come to you, but first, I'm mindful of time. If you had any questions to the audience, particularly before we go back, do you have any questions? Okay.
There is a question at the back.
I'm sorry. Oh, good. Thank you. This lights my eyes.
A question and a comment.
Yes.
Is tax an issue during exits? Capital gains tax, indirect tax? I think it is an issue. I just realized that you all didn't talk about it, but this is just a comment for all the investors. As you think about your exits, before you invest, you need to think about taxes, because we've had a lot of investors lose out on, you know, their returns at the time of exit, and also cash, which is trapped in some of our African countries, because we didn't think about how we structured our investments at the onset. Thank you very much. My name is Grace, and I'm a tax advisor. Thank you.
So everyone go to Grace for tax advice, clearly, when the exits happen.
Yeah.
So,
Fantastic pitch, Grace.
I'm sure.
Grace, thank you for that point. I think it's very, very well made. And maybe just to bring the point home for the other members of the audience, the US, EU, UK, all the markets where a lot of people in this room come from, capital gains tax is indexed to inflation. In some markets, we've moved away from indexing because inflation has historically, by the last couple of years, been so low anyway. In many markets in Africa, there's no indexing of capital gains to inflation. Even if there was, a lot of the investors are investing in US dollars and they're investing from dollar funds. But the tax offices, they don't care what currency your fund is denominated in. They care about their local currency, and they care about your capital gains in local currency. And we've seen many cases of investors who've lost money on an investment because they're thinking in dollars. and there's been a currency devaluation. But they've ended up paying capital gains tax. And, and it's a big issue. And I personally, I don't have the answer to that, but it's a big, big issue.
I think, yeah, just your own experience. And this is
What does the bell mean? Sorry, can we?
The bell just means we're time. Time, yes.
I think it also sort of falls back to my earlier comment of setting structures correctly from the beginning, whether it's legal structure. And I think what we might be missing slightly, and that sort of feeds into what you were saying, is the correct advice early on. So whether it's how the companies are structured, how the investments are structured, having the right legal advice, tax advice, accounting advice early on would really help smooth that process out a bit.
It's important, and the idea of an early stage business is one to not kind of overspend, but I think typically companies underspend and invest in governance and good governance and structuring from the outset. One trend that's happened, at least in the venture world, where companies are not just raising from Africa-focused investors, but more global investors, is that the domicile of the entity is now shifting to Delaware. I'd say 80 to 85% of the time, because people want to raise money from Sequoia, Index, Greycroft, these kind of well-known firms with billions of dollars. And therefore, we're domiciled in Mauritius, and Mauritius has double taxation agreements with a lot of the kind of African countries into which we invest. However, it's becoming less relevant, frankly, because the top codes are now generally Delaware. So that is a shift that is happening, which means, speak to, forgot the name, but Grace.
Grace.
And other advisors to make sure that you're doing the right thing on the way in. So that way, when it comes time to go out, you're able to keep as much of that hard-earned capital as possible.
Okay, good. Thank you. Thanks. That's our time. Thank you. Thank you, everyone.
That was very short.